everyone. Okay, let's try that again. Hi, it's Kara. We're going to get started in a few minutes. Let more people log in. And I'm happy to see all your names on the chat box. Okay, everyone, this is Kara, and I have Kathleen and Renee here with me, and hopefully you have logged in and can see a PowerPoint screen presentation. Is that what people are seeing? I just want to make sure I'm showing you the right information.
No, Kara, we can't see, at least I can't see PowerPoint.
What are you seeing?
Just the Zoom cover sheet. Without, So you haven't shared your screen yet, I don't think?
Well, you know, I'm trying to do this double duty business with two screens.
There you go. Awesome.
Now you can see it?
Now I can see it. Thank you.
Okay, thank you. So just to let everyone know, cover the basics, I generally keep everyone on mute just so we don't have the background noise. But if you have something you want to share, ask, please type it in the chat box. Kathleen's going to present, and I'll take note of all your questions if you put them in the chat box, or if you have any issues, please let us know and I will help you work through it. Otherwise, we will get started and I'll turn it over to Kathleen here.
Hi, thanks for joining us today. I have about 25 slides and several screens to show. How do I go to the next slide?
Just click. All right.
Nope, that's not right.
Roll.
Thank you. So the first slide, I want to address debt capacity estimate. So if we're thinking about debt service and we're thinking about bonds, you know, when we're not face-to-face like this, I'm not sure, except by your names in the participants, really what my audience is. Do you already have bonds? Are you a new clerk walking into a school that's got lots of bonds and never dealt with them before? Or are you a district who's never had bonds and you're thinking about it? So it's not as easy for me to,
Keep going.
it's not as easy for me to know my audience, so I apologize for that. I want to start with debt capacity. And so the first thing is, if we're even thinking about a bond, how much can we bond for? Well, you have a sample spreadsheet that's available in your handouts. It's called Estimated Debt Limitation Calculation. This is a point in time calculation. It's also required in the administrative rules that this document be requested either by your fiscal agent. And when I say fiscal agent, I'm referring to someone like D.A. Davison. And when I talk about bond counsel, I'm referring to attorneys who do bonds. There's one in Missoula with Dorsey Whitney that OPI sees a lot of activity from. So the debt capacity estimate is required part of information from OPI to either the fiscal agent or directly to the district, depending on who requests it. So I put together a worksheet, and if you need one of these, you'd have to call OPI to get it. But most of the time, the fiscal agent will ask us for it, and we provide it to them, so it becomes part of the information to get started. The calculations change every year due to the statewide debt service mill values and the district debt service mill values, and we're going to talk a little bit more about that. Those are calculations based on A and B changes every year. District's liabilities change every year. So I think at this point, it would be great if I could open up the spreadsheet or the handout.
Okay. I think I'll do that for you. Okay, go ahead.
Can you open it up?
Yep, go to here.
Yep. Here's an example of the spreadsheet. I'm sorry about all this technology, guys. I'm really bad. So what I was saying is that these mill value numbers change every year. Like these here are the state rates. These are going to change every year, but this is going to calculate the amount of debt capacity or the amount that you can become indebted. So this, in the yellow here, it'll say the district has to put in obligations. You can look at this later in detail because I don't want to spend too much time on it, but just know that debt capacity's golden rule is basically 100% of your taxable value. The exceptions are when your school district's debt service mill value per A and B is less than the state. And then this calculation comes in and it'll calculate, because not everybody has a generous taxable value. But a golden rule would be, how much can we bond for? How much can we get in debt? 100% of your taxable value. The legislation increased the debt capacity that is available to school districts by an amount that really most taxpayers can afford and would not vote for. So know that the law has made it very generous to go into big debt. The sky is not the limit. Actually, it's taxpayer approval. So even though the law allows you to become indebted up to 100% of your taxable value, that doesn't mean that your taxpayers are going to support you or can afford it. So I'm going to move on to the next slide if I can figure out how to get back.
P.
Click what?
There you go.
And then how do I close this?
There you go.
The next thing is, what kind of bonds are there? Well, we're going to talk about general obligation bonds. That means these bonds are voted and that they are on the full pledge of full faith and credit from the taxing power of the school district. That means that you have, as a district, the authority to tax for the payment of general obligation bonds. And our discussion, like I said, is going to focus on general obligation bonds. Another type of bond is something called the revenue bond. Montana school districts, we have 2 school districts that have revenue bonds. They're usually schools that receive impact aid, so they're called impact aid revenue bonds. They don't get to levy their taxpayers. They also don't get any state assistance. Revenue bonds means that there's a different revenue stream that's going to fund that debt outside of taxpayers. So a couple of types of bonds. Oops. So some of the assumptions that I'm making at this point in the presentation is that the district's been working with a fiscal agent and bond counsel. We have project design contracts. Obviously we've had an election that passed. We have debt capacity statements from OPI, and we just looked at those. We have our public notifications done, architecture and engineering bids, voter approved, the bonds have been sold on the market. The official statements have been issued and the closing statements. We understand our mandatory reporting disclosures, and we probably contacted our auditor. And if there's any state subsidies that would be available for our bond, we've been made aware of those as well. There's advance estimates, which means here's an estimate of some subsidy from the state for GTB debt service that you might get if you're eligible. The state of Montana hasn't had funding in this area for 4 years. We don't in 2020 either. It's not just for new bonds, but it's for all bonds that would be eligible. Maybe in 2021, we have authority, but we'll see if we get the revenue in 2021. The amount would not be material to the financing of any of the new bonds. It would just be a little bit of money that would be prorated to everybody that's eligible. So it's not coming back as it used to or a big factor for financing. And I said, part of the assumptions I'm making here is that you understand the mandatory reporting disclosures. In our handouts, if I can figure out how to go back to a handout. I want to pull up this one called Emma information. Emma is a website this is in your handout, so everybody has this. It really has to do with the Municipal Securities Rulemaking Board. And this is where everybody who has a bond, any municipality, and so like it says, Municipal Securities Rulemaking Board. So of course, local governments are municipalities, and so you have some electronic reporting requirements that are mandatory through this website. So I've attached that in the handouts, and actually, if you have time and can spend a little time looking in Emma, it's a wonderful resource just to see what bonds are being sold by other school districts, how much they're selling for, all kinds of information. So that's why I included that in the handout, so you just know what I'm talking about with the understanding your mandatory reporting disclosures. Okay, so close. Go to PowerPoint, which is where?
E at the bottom.
At the bottom of this, just like normal.
Yep.
Okay, so we've talked about the bond types, the assumptions that we're working with. We're going to move on to bond terms. State law allows a bond term not to exceed 30 years. We don't have any bonds that are issued for 30 years. We have 20-year bonds for the majority of the school district bonds that have been issued. This law has changed in 2017 from 20 years to 30. Refunding bonds have different laws and different schedules. So the 30 years is for general obligation bonds. The 30-year term will probably never pass a vote. It's a big taxpayer obligation for 30 years. There aren't any bonds in Montana that are greater than the 20 years. Intercap bonds are a little bit different, and they have a 15-year term or the useful life of the project, whichever is less. The trustees have a mandate to budget. The law requires trustees to budget for a debt service fund if they have principal and interest due, if they have a SID, which is a special improvement district. So districts having outstanding general obligation bonds should include in the debt service fund of the final budget the amount to pay the interest and principal becoming due for the ensuing year. They also have an obligation to make sure that they've levied for special improvement district assessments and can, in certain cases, have what's called a limited operating reserve. Special improvement districts, I want to talk a little bit about those. They're sometimes called SIDs, Special Improvement District, or RID for a Rural Improvement District. Some of you are probably familiar with them as you probably pay them every year. They can be 10 years long, and what they are is a tax assessment from your county that is levied through the debt service fund. So if you have a SID or a RID, you're going to get a bill from the county treasurer, and you will be able to levy for that bill through the debt service fund under the special improvement district assessments. They can be 10 years long, they can be one time only, or they can be perpetual. They're for things like street light upgrades, sidewalks and curbs, or sewer improvements. So part of my property tax bill in the Augusta area includes a SID for the Augusta School District area, includes actually a RID on my tax bill for an upgrade to a sewer system. So we see them, taxpayers see them, and school districts see them. I want to also let you know that if we see levied in the SIDs or in the debt service fund for a special improvement district, OPI watches that to make sure that those are compliant. And the other thing that the trustees are mandated to budget for is a limited operating reserve. And I'm not going to talk about that much now because I have that coming up in a different slide because it really is very limited. So bond proceeds. So under our assumptions, the bonds have been sold on the market. Those proceeds, all proceeds must be credited to the building fund. Proceeds go to the county treasurer. The county treasurer shall credit the money to the building fund. The money is also immediately available for the school district to spend without budget authorization. Well, what does that mean? That means that if we sell the bond and the proceeds come to us in February of a fiscal year, we didn't know about it when we set our budget back in August and September, but these proceeds are immediately available for you to make expenditures out of the building fund for anything you've incurred. And most likely it's for the architect and engineering bids. Those are some of the very first expenditures that you have that are outstanding, waiting till you get the money from the bond proceeds. Remember the stated purpose authorized. The ballot language and indenture documents state the purpose in which you get to levy. This is especially important when the bond has been paid off and the debt service fund has a residual balance. The taxpayer is authorized a specific amount of principal debt and the purpose for which those funds can be spent. The ballot language is also written so that a district can apply stated purpose with some discretion. So although funds are immediately available, remember they're authorized for a specific purpose. The county treasurer makes all the bond payments. Those entries are done at, obviously, in the treasurer's office. Once those coupons have been paid for principal and interest payments for bonds, they shall promptly notify the clerk. And also that once that's been done, canceled coupons and bonds go to the county clerk. So the county responsibilities when a district has a bond require a little bit more on their end as well. The treasurer is really responsible for bond payments. Districts should verify those coupon amounts with the legally scheduled amounts. So let's talk a little bit about Mayfair scheduling. So I need to open a handout. So the final bond schedule, make sure OPI has received a schedule, your final schedule, and that your county treasurer also has it. You'll get those from your fiscal agents. I want you to notice the semi-annual interest and principal payments that are stated on those final schedules. Also be aware that OPI will schedule due dates with a June 30th fiscal year ending date. Some of the schedules come out with the 7/1. We'll take a look at a couple schedules here. Wow, this is bad. All scheduling of bonds, of course, is done by OPI and Mayfair, so the district isn't able to do that. So now I want to go to here's an example of what a final schedule looks like. In this example, I can zoom in. What I want you to notice is these period ending dates. This bond semi-annual interest payments are scheduled in December and June. This is a perfect schedule for OPI because we don't have a conflict with the fiscal years here. And that's one example. In this example, what I want to show you on this bond schedule is that this is dated 7/1. January 1 is one fiscal year. It ends in June 30th. And then here we have July 1 with a principal payment. So we have some interest payments due. OPI is going to schedule this bond as these two payments are in the fiscal year 2020. This will be scheduled with the June 30th, 2020 period ending, regardless of how the final schedule is done. So that you have, and this is important to understand if you have a bond, so that you can reconcile your final schedule to the payments and the scheduling in Mayfair's. So this is a good example of when we get one of these schedules in like this, to us, this is entered as a June 30th date and should be on your records as well. Back to the beginning. So we're going to talk a little bit more about the dates of those payments and the issue. In order that the dates of the payments of the installments on the school bond issues coincide almost as nearly as possible with the largest monthly tax collections, all school bonds should preferably bear a date of some day in June and December. So in that example that we just looked at, which I said is not what OPI likes to see, that was a January July. And so as you can see, to us, that's a June date. Property taxes are collected in November and May, and so what this statute is saying is you will have the money to make your bond payments when tax collections come in November and May, and so of course that would be December availability as well as June. I think it's really important that you guys understand how OPI schedules the semi-annual interest periods. And that'll become clear, I guess you can see once we get into some of the Mayfair screens. So you have your final bond schedule, you understand how the fiscal year semi-annual interest payments line up with it's in Mayfair's, and you need to verify the bond schedule in Mayfair's matches your final schedule. You also always need to review the bond annual records. And so I'll show you what those are.
It's in the movie of,
Here. We're trying to sign into Mayfair's, figure out how to do it here.
should be open quick on everything.
This?
Oh, see that there.
Okay. So in Mayfair's data entry, we're going to go into some of the budget steps for bonds. And we're looking for, so they're going to see this?
Not impressed with it.
Data entry, budget. Let's pick on Anaconda. We have them on the phone or on the webinar with us today. So what are you doing? Going to bonds page, schedule report. This stuff. Is this?
Thinking.
Here's what a bond schedule looks like in Mayfair's. This example just have, first one comes up as a refunded bond, but here's one that's been paid up. What I want you to see is that Mayfair schedules fiscal years. So in this, you can see principal that was scheduled and the principal that was budgeted. And so scheduled interest and budgeted interest. And we don't show the semi-annual interest payments. We don't have that line item detail that you're going to see on your final schedule. So that's why it's so important that you make sure this Mayfair is entered, scheduled by OPI personnel, matches what you get from your fiscal agent. That's what I wanted to show. Obviously, it's the first time I've ever done this, guys, so I apologize. How do we pay for the first interest in a payment? Well, let's talk about the first year budgeted. Our district issued bonds in February of 2020. Fiscal year 2020 budget was finalized back in August. Now we have bonds that are issued in February. We have an interest payment due in June. We don't have a fund balance in debt service, and we don't even have a debt service fund established yet. How do we make the payment on this first interest? Was the first interest payment included in our proceeds? If the payment is included in the financing, the closing documents will direct the Board of Trustees to direct the treasurer to put some of the proceeds into the debt service fund. Now, we just looked at the statute that said all proceeds have to go into Fund 60, the building fund. Some exceptions can be made when the timing of the financing for the payments due fall outside of a budgeted period. So if this is applicable in the first year of your bond, you'll be fully aware of it. It's a big deal to happen like that. So there are avenues to do it. It's actually, you know, an exception. If the proceeds don't go into the first payment, the treasurer will make the payment from any available district funds. So the treasurer has a statute that they have to make the payment. So most school bonds are sold at a premium. So you have a $10 million bond, but your proceeds are actually 11 million. That's why sometimes we're able to see through the closing documents and bond counsel and the structuring of this debt that some of those proceeds may be able to help the school make the first payment when they have not yet had an opportunity to levy taxpayers. So we'll take a look a little bit more at that. What is? So if the interest payment was made by the county, the district will include that reimbursement to the county in the first year budgeted. And I'll show you how to do that. The district will include the amount due to the county in the upcoming tax levies. So I want to show you another handout now. So hopefully I'm getting a little bit better at this. So my handout is interest from proceeds. Right there. Here's a schedule I received from DA Davison that says this first interest payment on this bond is to be paid from bond proceeds. So that's an example that I was talking about. Sometimes some of the funds from the proceeds of the bond that are sold at a premium can be made available to help the district make the first interest payment in advance of a chance for them to have budgeted for it and levied for it. And this is an example of that. It really is the exception, but I wanted to show it to you guys because right now in all the financial crisis that go on, a lot of things can be done to help school districts get bonds, make their first payment, and get on the tax rolls to be able to address them. I'm going to spend a little bit more time on this slide. We can recover that amount that was paid from the proceeds because the proceeds are for our project. We're able to recover that amount in the next tax levies. And we're going to do that through a budget code in Mayfair's called Add to Fund Balance. So again, I want to go back into Mayfair's, which is this thing. So data entry budgets. So there's no activity obviously yet in a 2021 budget for a school district. But what I want to show you here is add a new budget code under budget and reserves. Budget code 0003 says add to fund balance. I am restricted in my budget to exactly what was on my schedule that OPI put in here. Okay, I'm not, yeah, that's not what I wanted though. I wanted to see their annual records. And I don't know how come I can't. No. No. That's for us only. Shoot, I'm not able to pull up a very good example here. We talked about SIS, I guess we can look at that. These are closed periods, so I'm really restricted on what I can show you. So if you had a SID, it would be this screen here, which is under data entry budget steps 5. But I wanted to address this add to fund balance, and I'm not doing very well with that. It's a budget code in the debt service fund budget. Okay. So budget code 0003 can be used to recover the funds that were made either from the proceeds or on behalf of the treasurer in the first year of the debt service. Sometimes you'll see us use this field also for taxes receivable and specifically in the year of maturity. Okay, we're going to go back to PowerPoint. The annual budgeted bond records should show for each fiscal year of the outstanding debt. I wasn't able to get into what I was looking for on that screen, and I don't want to spend the time messing around in Mayfairs. These payments are made from your tax levies that are collected in other budgeted non-levy revenues. And if you're lucky enough to have a fund balance and debt service that has interest income, oil and gas, coal gross proceeds, or other revenue. State subsidies may also be available for eligible districts in May. That's an annual payment that OPI will make when we have available funding from the legislature. I want to go back into Mayfairs. I'm going to go to the balance. Okay, I'm trying to get to the 19. Here's what I'm talking about in an example that a school district added to fund balance $4,000. Now I want to take you into the trustees, and I want to go into the balance sheet. And you can see that they had a deficit of $2,000 in their debt service fund from the prior year. So in this scenario, this school district obviously has a cash deficit as well as a large amount of taxes receivable. So in the following year in the budget, we saw those entries where we added to fund balance 4,000. We have a deficit of 2,000 last year, and we have every reason to expect the same deficit in cash this year. And this is unique to this district situation. So in their judgment, they needed to levy an additional $4,000 in their debt service fund budget for some issue. So I don't want you just to consider your current year situation, but also remember to think about the circumstances that caused that deficit last year. Do they still exist for this year? And so make sure that you take that into account when you're budgeting. If you're a sinking fund bondholder, there's a lot of other considerations. I don't want to get too much into the sinking fund bonds. They're very complex and not, and we aren't issuing any sinking fund bonds anymore. We haven't seen those since probably 2011.
Can I ask you a question, Kathleen? If I were a district and I thought I was going to have that shortfall, could I just add that into my own budget based on my own judgment, or how would I go about it if I'm that hypothetical district?
No, that has to be supported. And any entry that you make in 0003 will be a compliance trigger at OPI. So we monitor any ongoing budget activity that includes budget record 0003. You can't just plug your budget because of any reason other than one that's legitimate.
So the best way for me to go about it would be what, to call OPI and work with you to get that added in?
Absolutely.
Or Mary in the future?
Right, right. To make sure that you're doing it right. And if you don't call us, we're going to call you. So we'll talk a little bit more about add to fund balance, but just be aware that any entries that are made in there, is a compliance issue for OPI. So we will be talking about that. Thanks. Okay. I want to go back and talk a little bit about the mandate for the trustees to budget in the debt service fund when they have existing debt. One of the mandates included a section that referred to a limited operating reserve. The limited operating reserve is exactly that. The authority allows districts to set aside a limited operating reserve. Of course, you have to have a cash fund balance from the year before. And the purpose of a limited operating reserve is for any bond interest payments that might be due between July 1 and June 30th, or excuse me, July 1 and November 30th. And we don't have any bonds that are scheduled like that anymore. As you saw, their dates are generally January and July, and we changed the July to be June. And but you do have authority for a limited operating reserve. I don't expect to see limited operating reserves in anybody's budget. The bonds are scheduled outside of this time range. If your district needs a limited operating reserve, you can budget for it. There are exceptions, and in the final year of maturity, maybe one of them. OPI monitors compliance with limited operating reserves. This means we will contact you for justification if the amount is material. So, and like I said, we don't see those. We don't have bonds scheduled where that is applicable, that you have an interest payment due between July 1 and November 30th. But just be aware that the limited operating reserve and the debt service fund is not like operating reserves in any of our other budgeted funds. And also be aware that that's another area that is monitored. So let's get into Mayfair's with our new bond. One of the step one in Mayfair's is entering your taxable value. Step two is you allocate taxing jurisdiction amounts. So when we take a look at this, OPI will set up a taxing jurisdiction label if the district doesn't currently have one from a previous debt activity. The district can use the label they want as a reference to the bond. Examples are Elementary 2008, Series 2019, and I've even had a taxing jurisdiction name something like Elementary Gym, referring to the project. So I can't see the screen because of this stuff. Can I move this? Oh, look at that. So in this example, when you come into the screen in Mayfair's data entry, and so Mayfair is so awkward for me to get into right now. This is data entry budget step 2. And when you come in here, you will put in the taxable value, and you will also put in, you will allocate your fund balance from the debt service is what you're doing. So the taxing jurisdiction in this case is number 1. Like I said, it's a label that's going to refer to the jurisdiction, which is the taxpayers who voted for this debt, the ones that are paying for it. They all live in taxing jurisdiction 1. The taxable value of your district, and fund balance is also stated in the Mayfair screen over here. So if you have $1 million here and you put in 900,000, you can't submit. And in that case, you might have had more, you would have had to have had more than one taxing jurisdiction. Districts can have more than one taxing jurisdiction when they have different taxpayers that voted for different bonds. If you have one bond, you have one jurisdiction. One group of voters that lived in one boundary that are paying for this debt. Districts that have had boundary changes or realignment will have taxpayers that existed in the old school district paying for a debt, and now the school district boundary has incorporated another part of the city or something, and it's a different group of voters with a different group of debt. And so you'll have separate jurisdictions. So you have one debt service fund. So your fund balance coming over in the debt service fund is one amount. The jurisdictions that fund balance belongs to to one jurisdiction, and in some cases, 2 jurisdictions. That's all the screen does. It says, take my TFS fund balance and assign it to the jurisdiction it belongs to. So I wanted to jump into Mayfair's balance sheet, but I think everybody participating today is pretty familiar with Mayfair's and the trustees and the balance sheet here. So I'm not going to try to figure out the computer part. But what I want to show you here is, here's the fund balance from the debt service fund for this school. That's exactly what came over into your budget for the next year. That amount is the one debt service fund balance that may be allocated to more than one jurisdiction. At this time too, I want to tell you guys, anybody who's got bonds, make sure you are familiar with the long-term liabilities report. It's pretty awkward for me to go back into Mayfair's and demonstrate this, but in data entry into your trustees, one of the steps is long-term liabilities. And when you go into long-term liabilities, you see compensated absences and any, I'm not sure what else you see. But the only way you get to see the bond information on your long-term liabilities is to print the long-term liabilities report. So when you're a school with debt service bonds, make sure you're taking a look at the information and the data that's coming through on the long-term liabilities report, because that also reads right from those schedules, and OPI puts the schedules in. The next one is step 6. Well, maybe. Step 6 is select and demonstrate the entry. Interesting. So what I want to show you here, and I wish I was in Mayfair, so I need to go into Mayfair, so people are just going to have to bear with me on this. I need to see this, and so I'm going to try to get into the part of the budget that I want to go to. Here we go. So in the budget, go to bonds payment. Here's the payment screen. When you come in here, this record's going to look like this. Oops. We're going to select it, and now we have to input some data. Of course, this shows for me, you guys don't get to touch this space, but the agent fees is looking for input from the district in order to save this record. So make sure this principal amount matches your schedule, the interest amount, and the agent fees. And so the district can put in 0 or whatever agent fees are charged. They will save this record, and then it looks like this, and that's what we saw on the screen. So right now I want to show you a handout. Included in the bond closure documents is the document that looks like this. And these are the stated fees. This acceptance fee is a one-time only thing, and that's not what we're talking about. We're talking about these paying agent fees. This is an annually, as you can see right here, it's annually, it's $400 a year. So in the Mayfair's bond entry screen, in addition to your interest and principal that's already on there and OPI filled, you need to put in these agent fees. And you save the record, and that's where you get that information. I also want to tell you that in addition to budget code 003, limited operating reserves, agent fees are a compliance issue for OPI. So you may be asked from time to time to show justification for the amount that you're putting in there and levying the taxpayers. So I'll close this. Debt service assistance. Trustees may apply the state reimbursement for school facilities for any outstanding debt they have, or the trustees may apply the state advance. So if your district is eligible for state debt service assistance, when we have funds available and appropriated by the legislature, OPI will issue subsidies in May each year. In the first year of a bond, advance payments will be issued in addition to the reimbursement. So what I want you to really get out of this screen is that there's two parts to debt service assistance when OPI has money. There's a reimbursement and there's an advance. Advances are only for eligible districts in the first year of the debt. In the first year of the bond, the advance payment will be issued in addition to the whoops, this dumb thing. In the first year, the advance payment will be issued in addition to the reimbursement. This allows a fund balance to be available for the ensuing year. These are separate components of the district's payment. They're calculated separately and they may not be the same amount. Montana legislature quit funding debt service assistance in fiscal 17 through 2020. And in these 4 years, we saw a decrease, of course, in school bonds being issued. What if my district doesn't qualify for debt service assistance? Well, local levies. Remember, as a general obligation bond, it's on the full faith of the taxpayers. So your only source of funding that debt is your taxpayers. OPI has a small budget authority for some debt service assistance in 2021, and I think I mentioned that in another slide. This will not be any significant amount of money to affect your financing. So it won't be a financing factor when worrying about how to make the first payment and setting up your bond schedule. We hope this changes in the future. I want to show you in this next screen, here's a debt service assistance report that OPI will put out on the website every May when we do have funding. And the part I want to show you here is down at the bottom. Here's the advance and here's the reimbursement. Roundup Elementary in 2016, when we had money, qualified for both an advance and a reimbursement under debt service assistance. And in this screen, what I want to show you is in the revenues and the trustees, and I can't see it because this thing's, there we go. So it's revenue 3120 when the state has funds available. Notice the amount is $64,000. That is the sum of these two amounts. You get one payment, you get one revenue. Just be aware that if it's the first year of your bond, it may include an advance. And you can also note that on both of these, the calculation for the advance uses different numbers than the reimbursement does. And there's a lot of factors that go into it. Also, I want you to notice under calculated, this says yes. So that means OPI is putting that number in your revenues and your trustees. So you always want to double check that stuff and make sure your records are aligned with that. In this screen here, I want to show you in the budget for, okay. In this budget screen here, what I want to show you is this is the amount of the advance. And the advance can be used for the current year obligations, and the reimbursement can be applied to the ensuing year obligations. And in this case, this is the advance amount of money. So you can see that this district has a new bond, has been notified by OPI that we have money, and you're going to get debt service assistance, and we'll give you an estimate of what that advance might be. So that goes into your budget as a revenue under other revenue 9100. And so you'll be notified by OPI and aware that you have one. Now I want to take a look at this. Okay, I'm going to back up to this screen here. OPI will notify eligible districts in year one of a new bond if estimated advance subsidies are available. What I want to show you is another handout. Okay, I don't know. It's not working for me, so we're just going to kind of skip that handout. What it is I wanted to show you a report that's posted also out on OPI's website, which is a debt service mill value report. It's pretty important to look at that. Is there any way we can make this
Click
thing
on
work?
the screen.
There we go. Thank you. What I do without Kara. So I'm going to go into. Here's what I wanted to show you. This is the district mill value. This is district mill value per A and B for debt service. And this is for fiscal year 2021. Right up here, we have the state averages for elementary, and we have the state averages for high school. How do you know if your district is eligible for state subsidies when we have them? Because this report will be posted out in January or February for the ensuing year. This is already out on the website. And if you're Dillon, for example, your mill value per A and B is 21.7, and that's $21.70. For the elementary statewide, it's 39. If you're less than this state number, you are eligible when OPI has funding. And so you can see that Dillon would be not expecting an advance because it's not a brand new bond, but they certainly could expect a reimbursement. That's what I wanted to show you. So you can monitor that kind of stuff and know if you're going to be eligible. Anyway, we're just about done, so thank you for bearing with me. I wanted to touch a little bit on refunding bonds. Okay, maybe not. Refunding bonds. Note, in order to issue a refunding bond, it has to be at a cost savings to the district. Bonds are callable after 10 years. That means after 10 years of making payments, my bond might be able to be refinanced. We don't expect to see any refunding bond activity anytime soon, as interest rates are as low as they can be and would not generate a cost savings, or it would not be a material cost savings. Districts that have bonds that could be refunded are contacted by their fiscal agent, but districts should monitor the economic conditions when economic conditions are different. Refunding bonds do not require a vote again. Talk a little bit about the settlement of the debt. Of course, there's early settlement if you're lucky, also at maturity, and then managing our inactive debt service fund. Early settlement of debt is not by issuing a refunding bond. It can be possible when the district has other revenue. For example, impact aid, some other source of revenue where you're in a position to settle the debt early. So you certainly can do that. Projects maybe, costs on the project maybe came in much lower and your board has made a decision to pay off the bonds. Otherwise, they just will run to maturity, and when we pay off our bonds, our taxes receivable will trickle in over the next few years, and we'll have this residual balance in our debt service fund. So the statute tells us that if you have any residual balance in an inactive debt service fund, what does inactive mean? Generally, auditors will look at no activity in a fund for 3 years as inactive. Well, you've got little revenues being put in there from taxes receivable that are being collected. So you have some activity. Your board can still make the decision if your district has no other outstanding debt for special improvements districts, or you're paid off your bonds, you have no intentions of bonding again anytime soon. You've got this $46.10 in your debt service fund, and you've got $76 more coming in for taxes receivable. Your board can make the decision to close the debt service fund, and any of those residual balances and any of those that will be coming in from taxes receivable can be directed to the general fund, the building reserve fund, or the technology fund. So the school board can make a decision, but keep in mind the use of those funds, however small or large, are restricted to the purpose in which the taxpayers voted for the bond. And as you can see, the law says to constructing, equipping, or enlarging school buildings or purchasing land for school purposes. So there is some discretion on the language in which the bond was voted. Residual equity transfers are not operating transfers, and so how a residual equity transfer would be used in this situation to close your debt service fund. Just wanted to bring to your attention that the debt service fund has some safeguards put in by law. There are a lot of exceptions that apply just to the debt service fund, and specific statutes that differ from the other budgeted funds. For example, there's no audit finding to the district if you have a deficit balance in a budgeted fund debt service. In any other fund, if you have a deficit balance, you've got an audit finding. In the debt service fund, that is one of the exceptions. So you can exceed your budget authority, and you will have a deficit fund balance at year end, because debt has priority. If you have debt and you owe money on it, it's going to get paid by you whether or not you have the cash. The treasurer is going to make sure it gets paid. She's going to pull that money from whatever cash is available at the district. Debt has a very high priority. Bonded debt, general obligation debt does. So make sure that you understand the laws, and they're all in section 20-9-400 that covers all the statutes. I've touched on many of them today. In bonded debt record retention, keep in mind the county elections office has some of these records, the treasurer's office, and as we saw earlier in the presentation, that the county has a lot of responsibilities to the payment for the coupons of the debt. So the treasurer's office has records, the county clerk has records, county election office has records, but we're going to talk about the district's responsibilities. And facility support files have a permanent retention period for records. So remember, 20-year bond is a long time, but because you bond for capital assets and facility projects, those records have a permanent record retention period. So, and I strongly recommend that all records concerning bonded debt are retained at the school district for the life of the school district. And that's it on my presentation. I wanted to make sure everybody's aware that the budget instructions, of course, are also posted out on our website under budgets, but much more importantly are the fund instructions. So if you're inside the debt service fund, the fund instructions are one of the tabs that are available to you. And those have been updated so that you're provided with guidance on the entering for the principal and interest, well, for the bond activity and records, and so those are available. And again, the laws that govern bonded debt, 20-9 4XX. And that's all I have. So if you guys have questions, I'm happy to help.
So this is Kara. It looks like there was 2 comments, Alvina saying they have an impact aid revenue bond coming for the first time, and that's great. I think you, Alvina, I think you're box elder, if I'm right. The link to the debt service mill value report. Yes, Shauna, our debt service mill value report is posted on the website.
Under county.
Under county. Just because all of our mill value information is under the county.
I'll show you where that is if I can.
Yeah.
Nope, I probably can't.
No, you can't. Just click on go back to the internet, click on the plus.
The what?
There you go. And then go to opi.mt.gov. Then the other question, and I think that was Gwen, is the limited operating reserve, which you talked about a little bit after that. So I think that was answered, but.
Debt service mill value, here we go. Where am I? I'm gonna back up, show you this again. Of all places, it's under county, and it's under county because of a lot of reasons. So under school finance, county, you're gonna see, these don't exist anymore. Under debt service mill value, here's that 2021 report that we looked at, and our example was Dillon with our state rates up here. So that's where that information comes from. I'm sure we could post that any place that you guys think it should be posted. Because if I was a school district, I wouldn't first think about going to county. But that's where it is.
Okay, I'm going to unmute everyone, and if you have a question, now is a really great time to ask that.
Hi,
Okay,
this is Carrie from Gallant Gateway. We are just finishing up paying off some bonds next June. And I was wondering how that works for our bonding capacity if we went out for a bond like in January or February of next year, right before our final bonds are paid off.
Carrie, the calculation for the debt capacity estimate represents a point in time. It's when you do it, because part of that includes your current liabilities and long-term liabilities. So you can try to capture that as of today. Debt capacity by both your fiscal agent, if you're working with DA Davison and bond counsel, recognize that you're going to have a settlement of debt in 2022, and your capacity at that point in time would change. And they can, so to answer your question, how does that affect our debt capacity? It's taken in consideration by bond counsel and the fiscal agents. So you look better.
Oh, okay, great. I was
Like I
kind of
said,
wondering.
you know, the way the statutes are right now, it's kind of like the sky is the limit for how much school districts can incur in debt, stuff beyond anything taxpayers would support. So, you know, it's very generous. It's extremely, it's very generous. So, to answer your question, they'll take that into consideration and it will net.
Oh, okay. So it's still, because it's still on the books, it takes away from our total bonding capacity until it's completely paid off.
Well, at this point in time, right? Because it is a point in time. So if we're talking today, it's on the books, right? But they're going to they're going to prepare a debt capacity. When I say they, OPI is going to give you an estimate, right? And then DA Davison is going to prepare a document that debt capacity will show the settlement of the debt in the future. The bond won't be issued till then. They'll make it work for you.
Okay.
Right
great.
now, if you're going to produce a debt capacity estimate, it's whatever's on the books today.
Okay.
Okay. I mean, even if you have a payroll liability outstanding and you're going to have payroll tomorrow and settle it, I mean, if you did it today, it should be reflected on that. And there are a few exceptions, and those are stated at the bottom of that debt capacity report.
Okay.
Okay. Good luck on the new issue.
Oh, I hope so.
Yeah.
Kathleen, this is Gwen Anderson. So
Hi, Gwen.
still, I need some clarification on the ability to have some kind of a reserve, because I'm concerned about whether or not my taxpayers are gonna pay their taxes in May. And I think I'm going to experience a shortfall. So the mechanism for that is adding to fund balance. And
Well, it hasn't happened yet, Gwen. So let's see if you get a shortfall. Let's see what kind of debt service fund balance you have. And if it's just one issue that's going to have a deficit, or do you have cash available in your debt service fund?
well, last year I was short $12,000.
I know. Yep, I know.
So I wrote it in as a liability, and I know it hasn't happened yet. So
Right,
be patient for a minute, right? Okay.
right.
So if I have a shortfall, I can write that into my add to fund balance and send you the documentation of the shortfall, and that's what I need to do.
That's correct, Gwen. And what I want to see you do when you add to fund balance is, okay, I was short last year, I'm short this year, I'm going to be short next year. Why are you short? Is it taxes receivable? Because you're going to get those, you know, one in some point in time, right? But that doesn't help you make your debt service payments tomorrow. So I understand that. Yes, so I don't just want you to think about last year's shortage and this year's shortage, but I want you to include, you know, an amount that you can support when you add to fund balance like that. So, you know, be careful. It's hard to do. So you're anticipating and at the same time wanting to protect your debt service fund. And yep, you can expect to, I'm retiring and Mary's going to take over. So when Mary takes over, you can fully expect her to question the support regarding add to fund balance. But you have big debt and a lot of issues with bonds that we don't see with other districts. So I'm sure it'll be an exception.
Okay, just needed that clarification. Thank you.
Yep.
Are there any other questions from anyone? Anyone on the phone that has bonds and has some insight they want to share with other districts? Okay, doesn't sound like it. So thank you everyone on the phone and appreciate it, Kathleen. You did a good job and we will post this on the website for later. And have a great day, everyone.
Thanks, Kathleen.
Bye, guys.